in the interest of time, we have to move on to our next panel discussion, where we will be talking about bridging the green financing gap, risks, and taxonomy. To moderate this panel, please welcome Jasmeet Khurana, Lead Climate Technology, World Economic Forum. Let's put our hands together, please, for Jasmeet Khurana. And our panelists for this panel discussion, please welcome Ajaya Bandyopadhyay, Asia Lead Climate Change, International Finance Cooperation. Ladies and gentlemen, put our hands together and have a round of applause, please. Along with Vibhuti Garg, Director, South Asia, Institute of Energy, Economics and Financial Analysis, and Dr. Arvind Bodhankar, Executive Director, Head ESG Practices, Dalmia Bharat Limited. Let's give them one more round of applause, ladies and gentlemen, welcoming them to the stage.
For inviting us, and we have a great panel today. We're discussing green financing. Green financing is just financing for green projects, but that's where the difference lies, right? We need, longer duration contracts. We need, concessional financing where required, and we need to fill the gaps, which is where the green component kind of comes in. Otherwise, it would just be called financing, which, it will probably be called in some time from now. But there are still gaps, and we need to fill those gaps, and we need, all the solutions possible. So let me start with you, Vibhuti, first. What is the gap in financing for the mission kind of 2070, which is our net zero mission, and how do we get there?
Right. So in terms of, given that government has set up the target of net zero by 2070, and there have been several studies that have carried out and assessed that India would need about, different studies have estimates between $7 trillion to $12.1 trillion is the need for, bringing about this net zero target. But even if we look at the short-term target of 2030, India needs about 400 to 500 billion of finance for the clean energy ecosystem. And if you'll compare what we are spending now is only 1/3 of that money. So there is definitely a big gap that we need to fill in terms of if we really are serious about achieving those targets. While there is no dearth of capital available, but there are some issues with respect to how do we address some of the regulatory and policy challenges. Because currently, if you'll see, in terms of India would need both domestic as well as international capital. And we have been since morning hearing a lot about ESG financing. So definitely that's a big pool of money that can help India meet its climate objective. And that in calendar year 2022, we had about $1.2 trillion of ESG finance issuances. But if you'll see the quantum that India was able to tap into, it's just $8.8 billion of that $1.2 trillion. So what we need is more stricter adherence to BRSR guidelines, as well as SEBI has proposed a framework for ESG ratings, but it's still not implemented. So we need these kind of reforms, which can again, more thematic bond issuances, kind of solutions that can help from the regulatory and the government side. Taxonomy can play a big role in that as well, because we need clearer definition to instill confidence to especially the foreign institutional investors who don't have an understanding in terms of, what constitutes green in the Indian context. We have more than 30 countries who have come up with the taxonomy. We have RBI and SEBI coming up with green debt security. So there's some level of understanding there, but still it's a little bit of, unclear as to, what would constitute green. So I think these are some of the reforms that we need to bring in.
And the number that you mentioned, which is, $7 to $12 trillion, it's a big number. Can you put that in context, of the Indian banking space, and, where do we stand now? For example, Indian banks have more or less financed the ramp up to 70 gigawatt, solar power and, 100 plus gigawatt of renewables, mostly through domestic sources with some, sovereign debt bonds,
Yes.
etc. But where is that $7 to $12 trillion number?
As far as the current RE growth story, renewable energy growth story is concerned, it's largely been financed by domestic sources with some amount of international capital coming in. But if we are really looking at the long-term plans, I think the domestic funding won't be sufficient. So the developers and the whole, value chain suppliers will have to tap into the international market. So that's where a big kind of chunk of money will have to come from international sources. Given, India is an emerging economy, we have a lot of our development needs. So I think there's a lot of pressure on the Indian financial system to meet other social and economic objectives. So while there is a big intent to meet even the energy transition goals, so I think, but the big chunk of money going forward will have to also come from international sources.
So, Dr. Arvind, coming to you next. Financing or green financing, depends on the maturity of the technology. Like we discussed, something like a solar which is mature, can be financed or has been financed until now mostly through domestic sources. It makes sense. Government has made, all the transactional or cash flow has been kind of taken care of for that financing to happen. But when it comes to nascent technologies or emerging technologies, what are the gaps that you are seeing, from the cement sector perspective, for example, and if we need the whole cement sector to go net zero, what are the levers in financing that are required to finance some of these new technologies that help you go net zero?
First of all, good afternoon, everybody. Thank you, Jasmeet. Thank you, ETH, for inviting me. I represent a company called Dalmia Cement, which is the fourth largest cement company in India, but perhaps the greenest cement industry. We were the first one to commit for carbon negative cement by 2040, and the commitment we did in 2018. And I'm very happy to share that since 2018, we have been able to reduce 15% of our footprint. Now, having committed for net zero by 2040, we definitely have plans in place. We put the roadmap in place, and in one of our plant at Ariyalur, which is in Tamil Nadu, which emits about 1 million ton of CO2 every year. And we wanted to first, make that plant as a net zero plant and then replicate that. So we immediately after committing for net zero, we went back, we did our exercise, and we thought of three technologies. The first one was urea, the second one was methanol, and third one was, of course, algae-based converting into annual feed, the CO2. Now, the urea was with TRL level 9, the TRL 9, and that was the most promising one. And for a 1 million ton kind of CO2 utilization, the capex requirement was about 4,000 crores and the opex requirement was about 1,100 crores. So the price of the urea was coming something around $425 per ton, and the cost of selling was somewhere around $375 in India. Now, there was a differential of about $58 to $60 per ton. So we initially, we thought because the technology is already established, we thought let's go to straight away for the financer and put up a big urea plant over there, absorb whatever it is, because India imports almost 15 to 20 million tons of urea every year. So we can definitely the first mover and we can capture the market which is available. But when we went to the financiers, while land and manpower and the other utilities were available with us, but we would still require a capex to build the machinery and buy the technology and markup. Unfortunately, nobody came forward because the payback period at that point of time was coming out something around 10 years. And people said, we knocked almost every international financiers, domestic financer. They say we are not ready to put so much of money at this stage. Then we said instead of going for a full-scale urea plant, let's go for a 100 ton per day kind of thing. That also required about 100 crores of rupees. But nobody came forward for that too. We said 50% of that we are ready to build in the form of machineries, in the form of land, water, utility, manpower, but nobody came forward. So the thing is that, one is that somebody has to come forward for the impact financing or risk-based financing, which will have a longer payback period. Or otherwise, the another thing is that the Article 6.2, which is the bilateral carbon market, or Article 6.4, which is a more open market, which has to come up where the prevailing prices are about $80. And if we could sell our carbon credits at a $80 price, we'll still able to earn about $10 per ton of this thing, and that will make the project viable.
Yeah. So Vibhuti, you mentioned the ESG framework and how that helps, and you're mentioning the carbon markets and how that helps. So these are two kind of big sustainable mechanisms which can drive capital into some of these green technology projects.
Carbon market plus impact financing. I mean, risk-based financing has to be there. Not necessary that we will, because carbon market prices will keep fluctuating. So there has to be a...
Yeah. So Ajay, coming to you from an IFC lens, IFC, of course, as we know, lends to the private sector and for these kinds of technologies before the private banks, or even the state banks get into this space. What do you think of these emerging technologies and how to get finance to these emerging technologies? What levers do the private sector need to pull off these projects, or the government needs to pull to make these viable like it has done in some other sectors before? So CCUS that Arvind was mentioning, or hydrogen, these are all areas I'm assuming IFC is already kind of looking at both from advisory and investment perspective. So where are the gaps for financing to flow?
Okay, thank you, and thanks for inviting me in this very interesting session. So when we today look at this whole gamut of emerging technologies in the climate space, so these are not really the standalone technologies, rather these represents a wider ecosystem. So whether you talk about CCUS or green hydrogen, it has a very large ecosystem to put in place to make it viable for industries to really leverage. So for example, in the whole green hydrogen, you have to put in place the renewable value chain, the electrolyzer value chain, transportation storage system, and then the off-taker system. So what we have understood as a financial institutions and being, the development-focused financial institutions, that it's not, it's not enough to put in the financing at certain spaces, but to look at the whole thing, whole gamut as an ecosystem and work towards the development of that ecosystem. So in a way, we work very closely with the industry stakeholders. We, apart from mobilizing the mainstream financing, which comes at a much later stage in the development curve of some of these technologies, we engage upstream with a lot of these players, with the industries, also with the government for reforming certain policies to remove the investment bottlenecks. And the predominant sources of financing, or other modes of financing at this point of time, are the concessional financing, in a term, or also called the blended financing. Now, blended financing, in a way, comes in a wide forms and shapes, as you understand. So, predominantly, we have been doing the debt financing at a concessional terms, but there are cases where the viability gap financing, performance standards, and also funding a lot of these pilot projects with the industries, financing some of the technical assistance studies with the industries to look at some of these technologies and their performances more closely. So that's where, in fact, we come in. Now, what we, in fact, understood from many of these experiences globally, that in a sector which requires a transformative impact, for example, decarbonization of the cement, decarbonization of steel. So these require certain transformational initiatives. So that's where financing one or two projects sporadically at a concessional terms won't really help, because the sector is structurally quite imbalanced. So that needs, as I mentioned, very sustained involvement at the policy space, development of the whole regulatory activities, and then putting money on the piloting, look at the experiences of the pilot, how it operates, how much successful it could be, and then it moves back to the mainstream financing. So that's the approach IFC has taken, a little different from the other mainstream commercial banks, which engages, of course, there are certain constraints and they come in at a much later stage. So that's essentially, how we are operating in this space.
Yeah, just to kind of recap, you talked about ESG financing, carbon credits, and the carbon markets overall, and the ecosystem creation where policy, regulations, and all of these things become really important. So these are kind of three big umbrella things that need to happen for finance to flow. But looking at international finance that you said is really important. Get international capital to a country like India, which is a larger kind of, or a microcosm of saying get capital from developed markets to developing markets. Of course, carbon markets will help there. There are also these multilateral, $100 billion under Paris Agreement, which is flowing through JF and GCF, etc. That's another kind of big umbrella. So what else can we do to get this international capital or capital, especially from developed markets to developing markets? Vibhuti, to you.
Um, I think as far as the GF kind of instruments are concerned, they can play more of a catalytic role. They will not kind of meet the entire needs, and that's where using some of those funds through things like blended mechanism, which blended finance, which Ajay just talked about. I think that's where a lot of unlocking of private capital can happen, because and all of different institutes, whether it's MDBs, whether it's philanthropies, whether it's equity or even the promoter equity infusion, or the other banks or public funds, say for example subsidies from the government side, can play a role in coming up with providing that risk capital, and that can unlock a lot of private capital. So I think they will play a catalytic role, but we need much higher amount of private capital also to come in for the large scale of targets that we have set up.
But do you think that this private capital will come based on some of the unlocking and assuming that with these some of the catalytic steps that are required are taken care of, or are there other levers that we have not yet explored that need to be pulled for that kind of capital to come in?
Definitely, based on technology readiness levels, I think there are different instruments that will play a role. So for established technologies like solar, when we are seeing commercial capital being available, there's no, again, private capital is open because they understand those risks. It's very well established technologies. So I think for those kind of technologies, private capital is ready to put their bets on. They know the returns are gonna be higher. Their payback period is more streamlined. But for the newer technologies, for the nascent technologies, where the risks are higher, that's where unlocking of private capital is crucial, and that's where more kind of risk sharing facilities, or even some of the instruments apart from blended finance, are if the issuances are done at a sovereign level. So say for example a sovereign green bond can really address some of those risks, because if it can build especially some of the foreign exchange currency risk, because that's again a big risk for an international investors when they're investing especially in emerging economies. So if we can have foreign exchange swaps, TCX to an extent is playing that role, but if we can have more domestic currencies, so for example rupee denominated bonds being issued. So I think those are some of the other things which can address and unlock a lot of private capital as well.
So Ajay, coming to you next, I think one of the conclusions that we are coming towards is for some of these emerging technologies, capital or private or getting private capital is the most kind of emerging issue, or what we need to do. What role does, of course IFC lends to private sector, especially for these kinds of to be that catalyst, but also looking at it from the group, which is the World Bank group perspective, in terms of some of the risk mitigation mechanisms, like what has happened for electric two-wheelers that World Bank facility has come in with SIDBI. What is the appetite of someone like a World Bank to solve for these challenges in some of these bigger technologies like green hydrogen, CCUS, etc.?
Yeah, I think there is no dearth of appetite, and we have very ambitious targets, ambitious vision to work closely with the government, with the private sector on these issues of decarbonization as a whole. But in this context, what we are discussing, one point I would like to emphasize that, see, when we look at this, the way the private sector wants to solve the issue of decarbonization is just not about focusing on one or two such a large ticket emerging technologies which are on the horizon, but traveling a transition pathway, which is very important. And I think most of the industries which were, say, a process plant, a cement factory, or even steel industries, chemical industries, it's extremely difficult to change shift the process overnight, or even looking at the green at one go. So the clean assets are important, but financing the cleaning up of the existing assets is equally important. And that's where we are also, in fact, focusing on some of the instruments like transition loan, or say the sustainability linked loan, which some of these Indian industries, or sustainability linked bonds, which already some of the companies have issued, which are kind of a bigger corporate finance corpus, which is giving certain flexibility to the companies to use that funds based on certain benchmarks of how much of the greenhouse gas intensity they can reduce, how much of energy intensity they can reduce over a period of time. So yes, financing of these emerging assets, which is as a part of the overall bank group, IFC, it's very much important. We are engaging with various stakeholders to really understand these domains in a much better way, so that our financing can be very effective, selective, and strategic in all these areas. But at the same time, as I mentioned, we are also closely trying to help these industries to travel a transition pathway and achieve the bigger impact in a short, medium, and the long-term point of view.
Yeah. I think our time is almost up, but Arvind, last question to you. In this context of you trying to get a CCUS plant or investment of up to 4,000 crores going, and the status of play for financing as it exists today, and some of the comments that have been made around getting to on that journey, what are the next steps for you from a financing perspective, and how do you get there?
I'm really stuck. I just came back from the COP. I was expecting that something will happen on the carbon markets, but nothing happened. GCF, I lost my hope. I have been hearing from COP15 Copenhagen that 100 billion will come. If you look at the number, it's just 10.3 billion. That to 2 billion were contributed by Mr. Sunak just few days back. 100 billion floor fund every year. Forget about every year. They have in last 10 years they have not done. So I'm very pessimistic about the international funds coming. Whatever is there, we have to find out our own resources, and at our own pace we will have to do. That's what is my gut feel at this point of time. Unless and until somebody comes forward and says that we are ready to fund for your viability, share this thing, viability gap, I think things are not going to move. Something drastically disruptive has to happen. Otherwise, net zero will not be possible.
So which kind of, let me try and conclude that by saying that, Vibhuti said that we need $7 to $12 trillion. It's, a large part of what's happening today is coming from domestic sources, domestic banks, domestic capital. But Vibhuti says we need a lot of international capital. Yeah, including private capital, and there is right now a gap to create that catalytic space where some of these investments get de-risked for private capital to flow in, which is where your project is kind of stuck as well. You were saying that you have little hope on some of these kind of multilateral processes to make that happen. It will need to happen through either the private sector itself or through domestic government and regulatory aspects, which are there you were also talking about. So I think that is maybe how we can conclude this session, to say this is where we are. Financing for proven technologies is working. It's flowing, both domestic as well as international, private as well as institutional. But for some of these emerging technologies, some of these international mechanisms need to work. If not, it will take more time than it should have taken. And organizations like World Bank, IFC are trying to support in that process by making some of those investments and getting the ecosystem ready. So that is how probably we can conclude and say that that's the state of financing or green financing today.
I think you're right.
Yeah. All right. Thank you so much to the panel, and it's been a great discussion. And thank you to the audience for being great as well.
Thank you once again to the esteemed panel for your very insightful discussion. Ladies and gentlemen, let's one more time put our hands together for Ajaya Bandyopadhyay, Vibhuti Garg, Dr. Arvind Budhankar, and of course our moderator, Jasmeet Khurana, for moderating that session so beautifully.